If there's one thing Indians love more than chai, it's discussing money. Like where to invest, what gives the best returns, and which fund is safe. But with so many mutual fund options, most people end up confused and pick one randomly. Or worse, they avoid investing altogether. But what if I told you there's a simple way to understand mutual funds? Today we are going to uncover what are the 5 main types of mutual funds and their 38 categories. Which type of funds is best suited for your financial goals, and how long should you stay invested in each fund for the best results? So the feast is ready, it's time to serve. Let's start with the basics. If you go to a restaurant, you'll see different sections on the menu like starters, main course, desserts, and so on. Now imagine mutual funds also have a menu, but instead of food, they have different types of funds based on where they invest your money. So broadly, mutual funds in India are classified into 5 main types. Each of these serves a different purpose in your financial journey. First, equity mutual funds. These funds invest in stocks, meaning you are essentially buying a small part of a company. The idea is simple. The company grows and so does your money. But let me ask you something. If you plant a tree today, will you get fruit tomorrow? No, right? It takes time. Similarly, equity funds works best in the long run, like 5, 10 or even 15 years. As they are linked to the stock market, they are volatile. But if you stay invested long enough, history has shown that equities gives the highest returns. Now, not everyone likes high risk. Some people prefer stability over thrill, and that's where debt mutual funds comes in. Debt funds invest in bonds, government securities, and corporate debt instruments. Basically, they lend money to companies and the government in exchange for fixed returns. These funds don't fluctuate like equity, and making them ideal for short-term goals or for people who don't want to take too much risk. But what if you are someone who wants the growth of equity but also the stability of debt? And that's where hybrid mutual funds comes in. Some hybrid funds invest more in equity and some invest more in debt. Also, some funds keep switching based on market conditions. This will be perfect for someone who wants good returns but isn't ready for full stock market exposure. Now let's talk about something called index funds or passive investing. We all have that one friend who doesn't like making decisions. They just go with the flow. And that's exactly what index funds do. Instead of trying to beat the market, these funds simply follow a stock market index like Nifty 50 or Sensex. This means there is no active fund manager making buying and selling decisions. The advantage is it comes with low costs and decent long-term returns. So if you want simple and hassle-free investing without worrying much about stocks to pick, you can go with index funds. Lastly, we have solution-oriented funds. Now I won't spend too much time on this because honestly most people don't need them. These are funds specifically designed for things like retirement planning or children's education. But the problem here is they lock your money for a long time, and in most cases you can achieve the same results by investing in a combination of equity and debt mutual funds. So unless you really want a fund dedicated to one specific goal, you can skip this category. Now that we have understood the broad types, the next big question is, within each type, which specific fund should you pick? Because mutual funds are further divided into 38 categories. I know, looking at 38 categories can sound overwhelming, but trust me, you don't need to know all of them. I'll focus on the most important ones that you'll actually care about when choosing the right funds for your goals. First, we'll go with equity funds. Here we have 5 key categories you should focus on. First, large cap funds. Large cap funds are like corporate giants of the stock market. These funds invest at least 80% of their money in top 100 companies like Reliance, TCS, Infosys, and HDFC Bank. So if you are someone who doesn't want too much volatility and prefer consistent returns over time, large cap funds are a great option. Next, mid cap funds. Now, if large caps are the market leaders, mid caps are the rising stars. These funds invest at least 65% of their money in companies ranked between 101 and 250. Think of them as a fast-growing startups that are on their way to becoming market leaders. However, with high returns comes the high risk. So if you are comfortable with some ups and downs and have a long-term horizon of at least 7 to 10 years, mid-cap funds can help you achieve better than average market returns. Next, small cap funds. Now, if you're someone who loves high risk, high reward investments, small cap funds might excite you. These funds invest at least 65% in companies ranked 251 and above. Small cap stocks are where the real multi-baggers opportunities lie. These are the companies that can grow 10 times or even 50 times over time, but the risk is also equally high. So patience is the key here. If you are not ready to stay invested for at least 10 years and handle extreme volatility, this category might not be for you. Next, let's talk about a category that gives full flexibility. It's flexi-cap funds. Unlike large, mid or small cap funds where the allocation is fixed, flexi-cap funds can invest anywhere. The fund manager can move money between large, mid and small cap stocks based on what's performing well. So, if you don't want to worry about choosing a specific category and want a well-balanced approach, flexi-cap funds are a great option. And finally, multi-cap funds. While flexi-cap funds have the freedom to adjust their allocation, multi-cap funds follow a fixed rule. They must invest at least 25% in each category of large, mid and small caps. This means you get a bit of everything. The stability of large caps, the high growth of mid caps and the potential of small caps. So if you are someone who wants diversification but with a structured allocation, multi-cap funds are a solid choice. Next, let's talk about debt mutual funds, the safer and more stable option for conservative investors. First, liquid funds. Liquid funds invest in very short-term instruments like treasury bills and commercial papers with maturities of up to 91 days. The biggest advantage is the instant liquidity. You can withdraw money anytime and it gets credited within 24 hours. And the returns are far better than a savings account but lower than the FD rates. So if you have extra cash lying around that you might need soon, a liquid fund is a smarter alternative to a savings account. Next, money market funds. If you are looking for something like a liquid fund but with slightly better returns, money market funds are an option. They invest in short-term instruments with maturities up to 1 year. So it is great if you need to park funds for a few months to a year and ideal for those who want to keep their money safe while earning slightly better returns than traditional bank deposits. Finally, gilt funds. If you want zero credit risk, then gilt funds are the way to go. These funds invest 100% in government securities, meaning your money is as safe as possible. Since the government never defaults on its loans, these funds are great if you want stable returns over the long term. But here's the catch. Gilt funds are affected by interest rate changes. When interest rates fall, gilt fund prices goes up and vice versa. So if you are investing in gilt funds, keep a long-term horizon, at least 5+ years, to ride out interest rate fluctuations. So we have covered equity mutual funds for aggressive growth and debt mutual funds for stability. But if you want a mix of both, then hybrid mutual funds are the only option. Hybrid mutual funds have different types, but we'll focus on 3 key ones that actually matters. First, aggressive hybrid funds. These funds invest 65 to 80% in equities and the remaining 20 to 35% in debt instruments. Since the majority is in stocks, you get high growth potential, but the debt portion adds a cushion against volatility. This category is perfect if you want to build long-term wealth while reducing risk slightly compared to pure equity funds. Next, conservative hybrid funds. These funds invest 75 to 90% in debt and only 10 to 25% in equities. This means they give better returns than pure debt funds, but without the high risk of full equity investments. Think of this as a FD alternative with a bit of equity spice. It will be perfect for retired investors or those who want steady and low risk growth. Finally, dynamic asset allocation funds. Now, what if you don't want to decide how much to put in equity or debt and prefer a fund that automatically adjusts based on market conditions? That's exactly what dynamic asset allocation funds do. These funds increase equity exposure when markets are low and reduce it when markets are high and moving money into safer debt instruments when needed. It is great for investors who don't want to actively manage their asset allocation but still want the best possible returns based on market conditions. Now that we have covered the different types of mutual funds and their categories, the big question is, which one should you choose? Because a big mistake many investors make is choosing the wrong funds for their investment period. You wouldn't buy vegetables for a month and expect them to stay fresh, right? Similarly, you can't invest in a small cap fund for just 2 years and expect great returns. So let's break this down into 5 time frames to make the decision super simple. If you are investing for a short period like few days to a year, safety and liquidity should be your top priority. You don't want to take risks and you need access to your money anytime. For such short-term goals, debt funds are the best choice because they offer stability and easy withdrawals. The best option here are liquid funds and money market funds. These funds are ideal if you are parking excess cash, saving for an upcoming expense, or even keeping an emergency fund. They are better than savings account because they offer slightly higher returns. On an average, the returns are around 4 to 6% per year. Now, if your goal is a little farther away, say 1 to 3 years, you still don't want too much risk, but you can look for slightly better returns than traditional fixed deposits. So, conservative hybrid funds work well here. So, if you're someone who's saving for a home down payment, a wedding, or any big purchase within the next 1 to 3 years, these funds are a solid choice. On an average, they give around 6 to 8% per year. It's better than FDs, but without the volatility of full equity investments. Next, for a 3 to 5 year investment horizon, you can start taking some equity exposure. You need stability, but at the same time, you also want your money to grow. Here, dynamic asset allocation funds, gilt funds, and large cap funds are great choices. So, if you are a first time investor or someone who wants moderate risk but decent returns, these funds are a good fit. You can expect 8 to 12% returns per year if you stay invested for at least 3 to 5 years. Next, for a 5 to 7 year investment horizon, you can take more equity exposure since you have a longer time frame to ride out market fluctuations. Here, aggressive hybrid funds, multi-cap funds, and flexi-cap funds fit perfectly. If you are looking for high returns but still want some level of stability, these funds are a great option. Over a 5 to 7 year period, you can expect 10 to 14% CAGR. Finally, if you have a long-term vision and can stay invested for 7 plus years, then equity funds should dominate your portfolio. This is where the real wealth building happens. For long-term investments, the best options are mid-cap funds, small-cap funds, and index funds. If you are someone investing for retirement or child's education or building generational wealth, these funds are the best bet. But keep in mind, patience is key here. Over the long term, these funds can generate 12 to 18% CAGR if you stay invested for at least 7 to 10 years. At the end of the day, it's all about your risk appetite, financial goals, and investment horizon. Whether you prefer stability or growth, there's a mutual fund category that fits your needs. So the key is to pick wisely and stay invested for the long haul. And that's all for this video. But wait, understanding mutual fund is just one part of the game. The real question is, how should you invest? Should you go all in with a lump sum investment, or is SIP the better strategy? Which one gives higher returns in the long run? And that's the lead for my next video, so stay tuned. Until then, this is Sabarish signing off.